answer your question, Pete, no, I've never done TV interviews.
There's this wonderful moment in which you're sitting off camera waiting to go on. And there's this huge sense of anticipation as you're wondering when somebody's going to point to you that you have to get up off your chair and get onto camera. So this is very similar to that at this point.
Awesome. Well, you're on camera. You're on in front of, we got 8 attendees live and hopefully some more join here. Yeah, so I guess I'll just turn it over to you. I don't know if you want to do a short introduction for yourself, or if what I said does it. I doubt it does it justice. So I'll let you take the floor.
Well, thanks. I appreciate it, and I appreciate everybody getting up early in the morning and sitting down in front of their computers and listening to this seminar this morning. I hope it's going to be useful to you, particularly as I've made some changes for the situation we all find us in right in the last week and a half, which is in a bit of a emergency lockdown type situation. And it's impacting all of my customers right now, and I'm sure it's impacting you. So I'm trying to make this very timely. And we're going to talk about reading financial statements, but I'm also going to give you some very specific things to look at when you get back to your office to know what you could be doing or have been doing to put your business in really good shape for the next few weeks and months. So let me kind of get started. I'm going to give you, I love
sorry,
quotes.
Pete,
So I'm going to give you one.
Pop in here for a sec? I want everybody to know that there's a question box up. You should be able to see it right in the live broadcaster. And so ask your questions as we're going through. There will be a Q&A at the end. And so hammer Pete with questions throughout, and we'll get to them. I'll sort of moderate them as we're going here and see when we can slide them in there. So sorry for interrupting you, Pete. You're good to go here.
Fantastic. So let's start off with a couple of quotes. One of them is Confucius. So this is a little over 2,500 years ago. Success depends upon preparation, without which failure is certain. So we're looking at a situation where we've not been able to do a huge amount of preparation, but we can do preparation now for the situation. And, you know, the other thing to remember about it is, you know, our greatest glory is not in ever failing, but in rising every time we fall. And I love being an Albertan, and as part of this great province, we have an ability to rise again every time something knocks us down. So we've got a situation in front of us right now, which is serious and is impacting all of our businesses and all of our clients' businesses. But I have no doubt that if we do what we do, which is be smart, be innovative, and do the right things, we're going to rise again. So let's kind of get started. Clayton gave us a short introduction to what I do. And I grew up in a small family business. So my dad ran a small business which was on commercial equipment. I got my hands dirty sweeping floors and rebuilding carburetors when I was like 5 and 6 years old. And I was able to actually put a carburetor back together when I was 8 years old, if anybody wanted to know the answer to that question. My mom ran a strawberry farm as well, so we were always working to earn a living. And I did work for many years with Fortune 500 companies, but have decided to move back to what I really love, is working with small companies. I have a really simple perspective of a business. I look at a business as your ride. And like any kind of good piece of equipment that gets you around, it has 3 major moving parts. One of them is it's got an engine to it, which propels you forward. It's got some gearing, which allows you to speed up and slow down, but also to change gears when the road ahead of you gets a little steep. And last but not least, you got to have some steering, otherwise you're going to crash in the ditch. And I think every business really has 3 parts to it as well. And today what I'm going to be talking about is the most important part, which is the basic engine piece of it. And looking at financials and forecasts as really the gauging system that says, how is your engine running? And to do that, what we want to do today is be able to help you understand how to read basic financial statements. Now, the big caveat is the smartest guy in the room is not me. It's actually Clayton. He's the accountant. I am not an accountant, but I do have a degree in commerce, and I do have a certificate in financial statement analysis from Sauder School of Business. So I do have an idea of what I'm talking about. Hopefully it'll be useful for you. It's going to be from a business owner's perspective, not from an accounting perspective. So you can take a deep breath at this point if you were worried about it. I'm also going to tell you what's not in your financial statements, which is really important to know, and to understand some of the information you're going to need to know to be able to make good decisions going forward. All right, reading the hidden story in your financial statements. There is a hidden story in there, and for those of you out there, I know there's a number of you that if I asked you to look at the last financial statements that you read, it probably has a date ending in 2019 on it, and you're not looking at it very frequently. And if you are, you're not quite sure what you're looking at, except maybe your bank account. And that is very normal for a lot of businesses. It's unusual for businesses to really understand their financial statements and to look at them regularly, but you should. And what I'm going to do by the end of this hour is give you and empower you with an ability to look at those financial statements and learn something from it that's going to help you run your business. I'm going to start off with probably the most underrated piece of your financial statement, which is not your profit and loss or your income statement, but I'm going to start off with your balance sheet. This is the story of what you owe, what you own, and what's left over. And when we're looking at how this applies to being prepared for the COVID-19 perspective for the next few weeks. All right, can you hear me?
We got you.
Beautiful. So thanks to everyone for bearing with us through this, through technology. All right. So we talked about the top part of your balance sheet, which is your assets pieces. That's the pieces that you own. You start off with your current and long-term assets. And basically the only difference between them is current assets is stuff you can turn into cash pretty quick in a fairly short period of time. Longer term assets are things that you're probably going to hold for a longer period of time. And if you had to turn them into cash, you'd have to go out and sell them and figure out how to liquidate them. That's the only difference. So in this case, we've got both current and long-term assets adding up. And in the bottom are things called liabilities. So let's talk about what liabilities are. Liabilities are the things you owe people. Current liabilities are stuff you have to pay in a relatively short period of time. Things like your accounts payable. That's are things you have to pay, you owe within typically 30 days. Long-term liabilities are things like bank loans. If you've taken out a loan that you can pay back over a period of time, that's a long-term liability. And the total of that are your total liabilities. Basically, what's left over is called shareholder equity. It's a plug number, basically, that at the end of the day balances the top and the bottom off. It's what's left. So the thing to know about your balance sheet is that it's always evolving and changing every day, every week, every month, every year. And so when you take a snapshot of it for the end of the year from your accountant for tax purposes, it's just a snapshot as of the end of your fiscal year. But it's a living, breathing document that changes constantly. Now, this will tell you some very interesting things. One of them is it's going to tell you if you're able to pay your bills going forward, and it's also going to tell you what your business is worth. How does it do that? Well, let's kind of get into it. The first thing is asking, can I pay my bills? Current assets and current liabilities. What you currently have and you can get your hands on quickly, things like cash in your bank account and accounts receivable, money that your customers owe you. That adds up to your current assets. Your current liabilities is what you have to pay in the short term. Things like your accounts payable, any current portions of loans that are due, and any kind of taxes or GST issues, payments that you are due and payable. So in this case, The way you figure out if you can pay your bills is you divide your current assets by your current liabilities, and that's called the current ratio. Fancy name, but it's just dividing one number by the other. If the number is bigger than 1, all it means is you got enough cash and accounts receivable to pay your bills. This is a critical number when you're looking forward in this COVID-19 environment. Understanding how to quickly look at your current ratio and say, have I got a problem paying my bills coming up, will change week to week, month to month. This is a number I highly encourage you to look at on a regular basis. Simple, but very effective. COVID-19. So if you're looking at your balance sheet, what are some of the immediate things that you should be looking at for balance sheets? 1, to improve that current ratio, increase your cash holdings by doing there's 4 quick things you can do. One of them is invoice faster. In other words, I've got a whole bunch of customers that they invoice after 3 or 4 days, which is pretty good. One of them bills within 48 hours. That's even better. The worst ones send out bills every 2 weeks. Don't send out bills every 2 weeks or at the end of the month. Get your invoices out immediately. Second thing is consider deposits and progress payments on the work that you're doing going forward. If you are typically billing at the end of jobs, think about taking a deposit at the beginning of the job. Think about taking progress payments if the job goes on for a while. I know most of you look at it and say, well, business as usual is people are good for the money most of the time. I bill at the end, it's a lot simpler. Under COVID-19, what you will find are people are going to get cash crunched and they're going to have troubles making payments. That's why the government's been announcing all these programs over the last week and passed an emergency measures bill last night to get $82 billion out there in the economy. People are going to have troubles. So if you're starting work, think about it. The second thing is really focus on your accounts receivable and convert them into cash as fast as you can. I've been working hard with clients to get them to look at everything that is 1 day past due and get on top of every one of those customers and get payments. It has been difficult, but the faster you convert it from a receivable into cash, the better off you're going to be, the more secure your finances are going to be. Fourth thing is continue working in billing, and we're going to talk about that in the importance in when you're looking at your income statement, which is the next part of this. So all of it is aimed to try and pump up your current assets as best as possible to get you in a better position going forward for COVID-19. Next thing, there are a bunch of payments you can legally defer right now. You can defer your income taxes to the end of August now. That's part of the government's programs. The Alberta government said the provincial portion of property taxes, if you have to pay it, doesn't have to be paid until the end of September. Utility bills can be pushed off till for 6 months and they won't disconnect you. Actually, it's for 90 days at this point, but it's likely they're going to extend it. So for at least the next 3 months, if you've got large facilities, warehouses that are running, you're heating with gas or electricity, these are utility bills you can start pushing off. Fourth thing, WCB. If you've got people working for you that you're submitting WCB payments for, you do not have to make those payments this year. If you've made this payment this year, you can contact the WCB and request a refund this year. You don't have to pay it until 2021 for you in 2021. This is getting cash back in your pockets. The other thing is request.
So Pete,
loan payment deferrals.
Pete, can you hear?
Yes, I can.
Let's let your internet catch up here for a sec. But what I think we missed there well, it got a little bit jumpy, was that WCB is being deferred until 2021. And in 2021, the government's going to pay half for you when it becomes due. Is that right?
That is the announcement. And if you go on the website, you will find that in writing.
Fabulous. Thank you. Looks like your internet's caught up. Let's move on.
Okay. The next one you're looking at is we're looking at loan payment deferrals. So this is going to be a big one to contact your lenders on and seeing whether or not you can defer some of your loan payments. This is not business as usual, but again, we're not in an environment that is business as usual. All of for personal mortgages, credit unions and ATB in Alberta has already said for personal mortgages, they will deal with it on a case-by-case basis, and your inability to pay your mortgage, they will defer. So for people that are out of work, this is a good thing. For business and commercial loans, nobody has stood up and said that they will defer loan payments yet, but I've already got clients that are making those phone calls and getting a reasonable response from their banks. This is something you should do proactively rather than wait for you to not be able to make your payment and then phone your bank and say, I can't make my payment this month. Do it proactively. They'll appreciate it. The other thing to think about here, and I'm going to get this moving forward, is reducing your payables. So tax remittances. So this is for that has to do with the payroll assistance that has been announced last week by the government. The way it works is you calculate your payroll, and 10% of your payroll to a maximum of about $1,300 per employee for the next 3 months to a total over those 3 months of $25,000 you can deduct from your tax remittances. So this is essentially free money for any business owner who has a payroll that they're trying to maintain and can still keep part of their doors open. This is $25,000 that will go back into your pocket and not into the government's pocket. This is not a bad program. It's not huge, but it's not bad. Renegotiate all of your loans and leases. I've had clients who already have had a success in getting 90-day deferrals on their lease payments on major equipments in their shop. This is a good thing to start looking at. Third idea is negotiate with your vendors for any quick payment discounts. I'm never going to say that you shouldn't pay your vendors, but what I will say is if you go to them and say, I owe you some money, it's going to be really tight. Will you get, if I cut you a check today, will you give me 10% off the bill? This is a time to negotiate. You will find some vendors who are so nervous about getting paid right now, they will allow you to pay less if you pay now. Take advantage of that opportunity and keep the money in your pockets. If they won't give you discounts, then negotiate to spread payments that you need to spread out over a period of time. These are all ideas that will help you to reduce your current liabilities, improve your current assets, and overall improve your current ratio. That improvement will put you in much better shape going forward in the weeks and months ahead to stay in business and come out of this in good shape. Okay. Now, what's my business worth? So let me tell you, it's probably getting worth a little less today than it was a month ago. But I can tell you what you're going to be looking at to get an idea how to keep value in your business. I work with business brokers as well, so I know how they go about valuating business. I have seen no less than 5 different ways to value businesses. All of them depend on who's writing the check, and what are they looking at? So I'm going to give that to think about. One of them is a balance sheet method, and it's often called a liquidation method, and it really applies for business that are non-going concerns. So if you had to close your business today and liquidate, what would your business be worth? Short answer is a whole lot less than if you're able to keep your business going. That being said, the way it looks at it is you look at the total amount of things you own, the total amount of things you owe, and what's left over. That equity is where that number called shareholder equity total is on your balance sheet. Now, some of your assets will be worth more or less than that, than what's on your books. Often, not always, but often the asset value on your books are higher than what you're really going to get to it if you have to go to auction. What that means is that bottom line shareholder number might even be lower. So this is not good news. Unless you have to close the doors of your business, my advice is fight like hell to keep it open, because your business will be worth more in general. Now, everybody's situation is going to be different, but this is a general rule of thumb that I'm going to put out there that says, if you're thinking that you should be shutting your doors and selling it off at this point, 9 times out of 10, that's not a good idea. The other method that people look at is called an income multiplier. So it's the business is worth something as a going concern by its ability to continue to create profit. So what you want to look at is, we'll look at it in your income statement in a little bit, but you want to look at your bottom line before tax and before depreciation, or what it's sometimes called as amortization. And so you add back any tax that's in that bottom line and depreciation. And if your business is generating under $1 million a year, it's worth between 1 and 2 times that number as a going concern. Over $1 million, it's worth between 2 and 4 times that number. People ask why. The key is that businesses that are doing over $1 million of profit a year in revenues, these businesses are typically much more stable and able to weather storms than smaller businesses. And people writing checks for businesses know that. So being big also means being in better shape. The other question people ask is the difference between a 1 and 2 multiplier or 2 and 4 multiplier is huge. What makes that difference? A lot of things. And I can't get into that today, but there are a lot of things about how well your business is set up and to run, how smart it is, how strategic it is within the marketplace, and a number of other things that are looked at that will double the value of your business. But now you know that an income multiplier typically is going to create a better business value as an ongoing entity than shutting your doors and liquidating, 9 times out of 10. Okay. Next, what I'm going to do is I'm going to talk to you about maintaining some positive bottom line so that you can continue to create some value for your business. And for that, we need to start getting into the income statement. But for maintaining your value in these COVID-19 situations, keep your current ratio as high as possible, which puts you in a position to survive, and then focus on your income bottom line, not just your top line. We're going to talk about that in a bit because it's so important. Now we're going to talk about is what you probably have paid more attention to than your balance sheet, which is your income statement, otherwise known as your profit and loss. So let's get into that one. So your profit and loss is going to answer some basic questions like, am I making money? Where did it all go? And how much can I pay myself? And especially when you're looking at tight financials going forward, That last question is going to be an important one. So how do we do this? First of all, I'm going to give you a little tour of your income statement. Your top line stuff breaks down your income into different ways that you earn money. In this case, it's got commission, leasing revenues, and miscellaneous stuff, which ends up to generate $209,000 worth of revenue. That's called your top line. What you need to look at in your top line is, are you breaking down the way you earn money into categories that make sense for you? In a lot of the businesses I deal with, it doesn't. And they've been lumped together for history or for accounting purposes, but for good. I strongly encourage you to think about how you break down your revenue into lines of business that make sense and keep track of it based on those lines of business, because that will help you to figure out where you're making your money. The next line, which is really critical, is your cost of sales, otherwise known as your cost of goods sold, or COGS. These are expenses that are directly related to making money. So these are the costs that go into creating the revenue. If you are in the construction business or you are building something, the cost of your raw materials is a cost of goods sold or cost of sales. If you have people who are working on the floor that are only building certain things that are creating your products, that is a cost of goods sold. That is not an overhead. If they're working to produce product that you sell, and that's all they do, they are a cost of goods. If you have third parties and contractors that you work on to produce the goods and services that you sell, those are costs of goods sold. These are things you need to be putting into these lines, and the best practice is identify the cost of goods sold directly that bucket together with the kinds of lines of business in the revenues, so that you can tell where you're making your money. So these are two key things that most small business owners don't do a good job of setting up. Virtually every time I go into a client, we end up sitting down, working with the accountant, working with guys like Clayton to set this up properly. Your revenues less your direct costs of goods sold creates what's called your gross margin. As long as you are creating gross margin, you are creating the opportunity for profit. This is an important number. Go back to your office and look at what your gross margin looks like. It tells you how profitable your revenues are in general. The next line down is the stuff that most business owners pay a lot of attention to, so I'm not going to spend a lot of time on this, other than things that are truly expenses and not costs of goods sold. These are things that you have to pay for to run your business overall. These are your overheads. These are the costs of doing business. So if you've got salaries that are things like accounting, office staff, people that work for you that are not producing goods and services for sale, these are truly expenses. Accounting and legal fees, advertising costs, sometimes your vehicle costs, because sometimes the vehicles aren't associated with any particular revenue. Memberships, dues, your facilities rent. Don't drive yourself crazy and try to split your rent into your lines of business if it's too complicated. It's an overhead. Your utilities costs, your IT costs, your phone costs, all of those things are expenses. This is what you subtract from your gross margin to get your income from operations. That's why it's important to not just understand your top line and your bottom line, but now we got to start looking at this in between, because they will tell you so much that you need to know. The business owner, about what to do about running your business in good times, but especially now that we're in the COVID-19 situation. Okay. So where did it all go? So a lot of business owners say, well, I made $209,000. I'm doing great. Well, not necessarily. Your direct costs, your cost of goods sold, your cost of sales were $109,000, which leaves you with $107,000 in this example. That's gross margin before all of your overheads. All of your overheads in this example was another $77,700, which meant all that was left over is $29,000 and change in profit. Often, I'll see small business owners not even putting their own salaries into these numbers. If you didn't even put your own salary into this number, any draw for yourself, that means that in that entire period, you made $29,000 that you could take some of it and give to yourself out of two. So you look at that and say, that's where a lot of the money is going. Now, I have to pay attention to this. So what can I pay myself? A lot of business owners look into their bank account and just grab some money out of the bank account. That's a problem because you may have to put it back. If in fact your accounts payable is higher than what's in your bank account and what you can grab, convert to cash from your receivables, then you may have problems paying your bills. In which case, what's in your bank account is not what you can take. Can you take your retained earnings? Well, not necessarily. If you have a problem collecting on your accounts receivable and your bank account is starting to shrink, your retained earnings doesn't really tell you your ability to pay your bills. Your balance sheet does. Can I look at net income from operations? Or retained earnings is on your balance sheet. Can I look at retained earnings? No, that's a point in time. Net income from operations, again, it's a point in time that says, doesn't tell me what I have available to pay my bills or myself. Can I look at current assets minus current liabilities? Much better. Because now I'm looking at it and saying, what's really left over in current assets and current liabilities that is likely to be something I can put in my pocket. But at the bottom line, you should probably sit down with your accountant and have a chat about what really you can take out of your business and put into your own bank account, okay? So the short answer to all of this is it kind of depends on your situation, but you need to look at both your balance sheet and your income statement to get an idea of what you can pull out for yourself and keep your business running. Let's talk about COVID-19 stuff. To protect your bottom line is absolutely key going forward. It is not about keeping people busy. I have heard this phrase so often in the last week and is the most dangerous thought going forward for COVID-19 situation. Keeping people busy has it translated in some cases to, I will take any work at any price just to keep the shop moving. This is a dangerous thought, and I want you to be aware of that, right? If you can do business differently and keep your doors open, do it. There are a lot of people who are figuring out how to work off-site, how to run different overlapping shifts so that less than a handful of people are in the shop at any point in time, and that they can keep physically distanced by 2 to, in some cases, 5 meters away from each other. Changing their wipe down procedures in the shops to keep things sterile and keeping them moving. All of these things are smart ways to keep working if you can do it. I know that at this point we've got some a lot of businesses that just can't possibly keep open. There are businesses that are in the retail business, or in the salon business, or in businesses where close physical contact is required. But if you can find a different way to do business, find it and keep your doors open one way. Second of all, if you must cut prices to keep things going, do that by going back to your suppliers, the people in the cost of sales, the cost of goods sold, and negotiate those costs before you cut your prices. So working with suppliers to say, I have to cut my cost 10%, what can you do to help me do that? Can you cut your prices as well, just for now? These are conversations that are but are absolutely essential in staying healthy through this next few weeks. Third, never sell stuff at 0 or negative gross margins. Know your costs. It is not better to take work and lose money on every dollar you make. This is insane. It will start to deplete your bank account, and you will get to the point where you will have to shutter your doors. So pay attention to your gross margin, know what you're costing, and know what you can quote for price. Reduce all of your non-core expenses. So in that expense bucket, go through it and scrub everything out of it you possibly can. If you don't need to do it, don't spend money on it today. And if you have core expenses that are absolutely important to keep going, reduce them by renegotiating them. If you need to cut thousands of dollars out of your expenses to keep your bottom line healthy, do it, and do it fast, and do it now before everybody else's pockets are empty. So the advice here is understand how to read your P&L and maintain your revenues, maintain your gross margin by managing your cost of sales carefully and your pricing, and look at your expense bucket and start cutting out of your expense bucket everything you don't need to keep the door open, and everything that you do need to keep the doors open, renegotiate every price you can now. Best advice I can give to you going forward. So how do I reduce my non-core expenses? Reduce your payroll. Layoffs are ugly. The alternative is to use the federal new program that came out last week on job sharing. If all of the people in your work will job share, you will cut your payroll by 50%. The benefit of this is you keep everybody working. They will make more money on job sharing than they will by laying them off and only getting EI. EI pays a max of $573 a week. If you job share, they'll get half their regular pay, and EI will give them a partial top up on top of that. They'll stay in better financial shape. The wage subsidy that we talked about, absolutely get on it and start figuring out how to claim your fair share of it. There are no forms, but you have to keep records of what you're not submitting in taxes. Defer your income taxes till August. If you don't need the money, it turns out it's fine, great, pay it in August. But if you need the money now, you have it. Defer your WCB until 2021. Defer your provincial property taxes till the end of September. The province is allowing you to do that. City property taxes, no announcement on that yet, but the provincial part, absolutely. Renegotiate all your leases and loans. The interest rates have dropped to 3/4 of a point, are likely to keep dropping, ladies and gentlemen. This is the time to renegotiate leases and loans. Now, if you do that this week, what you will find is that all of your lenders, all of your leasing companies are swamped with people wanting to do exactly this. Because they're being swamped, they're not cutting their prices very much on this. Wait a week. you will start to get people that will start to be interested in giving you better deals on things. And pay off your high-cost leases and loans with low-cost loans. There is availability of money out there in more than one way. Clayton knows where to find it because he and I have had chats about it already this week. But if you've got any really high-cost leases and loans where there's virtually no penalty to pay them off, and you can replace them with another source of low income, this is the time to do it. Smart money is to get cheap money. So I've now given you a whole bunch of ideas of how to read your balance sheet, but also what to do when you pull up your own balance sheet and look at it after this meeting to put yourself in better shape for the coming months and ahead. I've also told you how to look at your income statement and what to do about it to put yourself in good shape for the months ahead. There are some other things that are not in your financial statements that I'm not going to go into in great detail, but to know these things are important and you need to start thinking about these other pieces of information. Outside of your accounting system, there are 4 key things to look at. The number one for you today is going to be future revenue. What kind of work are you completing that has been uninvoiced? How much money have you got sitting on the floor right now? How many orders have you got that you can keep firm and keep busy with once that work is finished? The other thing is, how many quotes have you got out there and what has the close rate on those quotes typically been? It will probably be less than it would have been a month ago, but some of those quotes are going to still close. This is your future revenue. It's important to start calculating it to know where you stand. The other 3 is strategic positioning. This is one of the key things that will generate more value in your business and double your multiplier. Take a look at your payment commitments as well. What's your cost to complete the work? Do you have to buy something or pay for something to do that? What's your payroll look like coming up? What are the subcontractor bills look that are going to come up this week? And what are the third-party contracts that you're going to get invoices from this week as well? Know that number because some of those you can negotiate. And from your brand loyalty perspective, this is something that is going to help you not only now to stay busy, but also get you out of this quickly, is paying attention to your customers. Inside of your accounting system, it rounds up and adds up a bunch of things that you probably shouldn't be rounding up, adding up, and looking at as these 3 things are things like profitability. If you dig into profitability by product, which of your products or your services are making money? This is where we talked about earlier, having detailed lines in your revenue that match up with detailed lines in your costs of sales, cost of goods sold, so you can see which of your products or services are actually making money. Every time I break this down with clients, they are surprised as heck. Every time they find some line of business that is carrying the business and making the most amount of money, and other lines that are dogging it and dragging down the business. You can only do that when you dig into the details. By product, by the type of orders, sometimes if you're doing project work by project, and last but not least, some of you are dealing with customers which are highly profitable and some of them are dealing with customers that are not profitable. I have had clients where I've gone through this process and we've discovered pain in the ass clients where the margins on them have been terrible for years and they've decided to fire them. And as a result, their business went up because they were able to put more attention on the more profitable customers. If you don't know who those customers are, this is a time to start figuring it out. The other 2 are productivity numbers and return on capital. Productivity is important because it says there's a utilization number that says of the amount of stuff that I pay money for to generate income, how busy is it really? If I'm looking at equipment, how busy is my equipment? Is it running flat out, or do I just turn it on a couple of times a week? If I'm turning it on a couple of times a week, that thing may be costing me a lot more than I'm thinking. The other thing, looking at your employees, how busy are they doing 100% of the time, or are they doing work that you can't bill some of the time? And how much of that time are they wasting driving around in trucks, sweeping the floors, doing things that you cannot charge your customers for? These are productivity numbers. And the last one is a more detailed one called return on capital. This essentially tells you that for every dollar that I'm buying and investing in my business, am I getting a decent return for it? And this is a little more complicated to calculate accurately. This is something where guys like Clayton and his team can help you understand that number. But these are all numbers that are important in running your business that are not in the P&L and not in the balance sheet that you need to start looking at to run a really effective business. If you don't know how, ask for help. But even if you don't get started with this, the numbers that are in your standard P&L and standard balance sheet, these are going to help you go forward and give you the basic numbers that you're going to need to know to guide you to do the actions you need to take to stay healthy through this COVID-19 thing, not just physically, but financially. So, 5 questions to ask yourself at the end of today. Do I have enough business lined up to continue as is? Will I be able to pay my bills? Am I being profitable? Because that's important. What do my customers think of me? If I don't know, I'm going to start talking to them. And am I doing too much of my business with too few clients? And the short answer is over the next little while, you probably will. Now, one fun quote from Winston Churchill. We make a living by what, but we make a life. John D. Rockefeller also said, "It's my duty to make money and then to share it with my friends and community." We all need to figure out how to stay profitable and healthy through the coming months in COVID-19, not because we're trying to be greedy or because we're trying to hurt people. We're trying to create an opportunity for people to come back to work to. We're trying to figure out how we can continue to have a healthy business so that we can support our employees and we can support our customers and help them to continue to have a healthy business, and we can have a healthy community and economy. So all the things I'm talking to you about are things that may be difficult for you to consider doing, but these are things that are good things to do to keep your business healthy and going forward and creating a business that will be there in the next couple of months for people to come back to. And for that reason, I would like you to strongly look at your P&L, strongly look at your balance sheet and the current one, not last year's one, and use that information to start making smart decisions to sustain your business going forward. All right, so I think we're just about out of time, but I'm happy to answer any questions and stick around for anybody who wants to do that, unless Clayton needs to end this. So I'll turn it over to you.
Yeah, thanks. We've got a few questions through and a few comments here. I'll hit on them. One question came through about on my payments that are on direct debit. Should I just cancel my direct debit? To avoid having to make those payments. My suggestion on that one is to just call your vendors, and some of them won't actually provide you with services absent a direct deposit agreement. And then others like utility companies, for example, will allow you to defer. So it really is on a vendor by vendor basis. I think that one of the key takeaways from this presentation is you don't want to negatively impact your vendors too bad. So that was my thoughts. Do you have any extra thoughts on that?
Yeah, and I think the key thing is developing relationships with your key suppliers. You're going to need to have, going to need to sustain your relationships with your suppliers through this. If they start cutting you off, you are going to get in deep trouble. So the approach that I'm always recommending is phone up your suppliers and work through it collaboratively to help each other out. And some of your good suppliers are going to be working with you. Maybe not this week, maybe they are too swamped, but even if they say no this week, phone them again next week and try again. Eventually, everybody is going to come to the realization we're in it together, and together we're going to have to figure a way out of it. And a vendor will be much happier getting most of his money from you rather than none of his money from you. And they know it. And they'll work collaboratively when they know that you want to work collaboratively with them as well. So Clayton's advice is absolutely right. Don't do things one-sided unilaterally. Phone them up, have a discussion, get an agreement to reduce what you can reduce.
Thanks, Pete. There was another comment in from one of our contacts who's actually in finance, and his comment was most facilities have penalties to pay them out early. Fair enough. Some don't, like lines of credit, for example. You want to check the terms of your agreement. But more importantly, it's interesting to note that a lot of banks haven't yet reflected the Bank of Canada's interest rate drop. So, 15 seconds on any thoughts on that, or when we might expect something coming on that from the major lenders.
Yeah, I've been talking to a couple of the banks and some of the people that are dealing with major lenders right now, and because of the rapid and surprising drop by the Bank of Canada, what's happened is the demand for loans and mortgages has actually increased, and supply and demand, is ruling. So we're seeing that in some cases in the last week, mortgage and loan rates have actually gone up and not down. I suspect that that's going to start to ease off as some of the crush of applicants work its way through the system. I also think that they're going to get some pressure from the press and the politicians to start passing along the interest rate cuts more rapidly. So stay on top of it and know that the interest rate cuts are going to work its way through the system. It still may take a couple of weeks to get that through to a point where you can take advantage of it, but that doesn't mean you shouldn't start trying now. Thanks.
Thank you. Yeah, I'd agree with those sentiments. Banks will be banks, and there is supply and demand. So, you talked about a lot of deferrals in this program. We'll leave it on this note. I've got. Oh, sorry. Before we get into that, on a high note, for all of our clients that are on a payroll provider who aren't, doing their payroll by hand calculating things off CRA's website or through, QuickBooks Online or whatever software they're using, if they're with a payroll provider, the ones that we work with have inserted a toggle switch now to take advantage of the subsidy. I went in to ours and toggled it yesterday. It said, "Are you eligible for the wage subsidy?" Yes. Great. They're dealing with that now for you. And the thesis of that is I don't have to worry about the mechanics of that anymore because my payroll provider is taking care of that. If you're on automated accounting with Akin Henderson, we're taking care of that for our clients. Or we're helping with it anyways. We're helping people deal with that and with the payroll providers on the back end. Final thing. So you're talking about all these deferrals, and sorry, we're running over. We had some techie difficulties and all that, but we're deferring property taxes and utilities and WCB. WCB is a good one because they're actually subsidizing half of it. We're deferring loan payments personally. We're talking about all these deferrals. Is that really, even the payment of taxes and installments, is that really a good idea? Or is that going to just be terrible when it catches up to us in September?
It can be terrible. So the advice here is defer it, but stick it into some sort of bank account that you can improve your cash position on. So know that you're taking that money and setting it aside for that eventuality. Two things will happen over the next 3 months. Either things are going to recover very quickly and you're going to be able to pay off those things without any problem, or things are going to get worse and the government's going to announce more deferrals and delays and programs that you'll take advantage of. So if you do defer these payments, make every effort to not have to dip into it for now. Use it as an emergency fund to keep the doors open after you've done absolutely everything else to cut your costs and to renegotiate everything you can renegotiate. It's better to have it in your pocket than in the government's pocket in case you need to use it for some reason. And in case the government creates additional sets of incentives which allows you to not have to pay 100% of that when they come due. So get it into your pocket, put it aside, don't touch it if you can avoid it. Use it as an emergency, absolute emergency fund as a last resort to keep your doors operating and running if you need to, and monitor the programs as they roll out over the next few weeks. Everybody is telling us at this point that we're going to be living with this virus rolling through our healthcare system and our economy for many, many months. We will probably get it under control in the next 2 months if we do everything right. Even if we do everything right and we get it under control within the next 2 months, it does not mean that the economy is going to be back to normal. It's going to roll. It's going to come back and have to develop a little bit of a startup. And when we do that, the government's still going to be monitoring and doing what it needs to do to keep moving forward. So long way, the best thing is take the money that, instead of putting it in the government's pocket, put it in a bank account, set it aside as a rainy day fund. Don't touch it if you don't have to, but if you have to, you have the money to make good business decisions in your control, and you don't have to go and apply for it from somebody else. And yes, be prepared to pay it, but also be prepared that the government may roll out some more programs in the next little while.
Perfect. Thanks, Pete. I appreciate it very much. Everyone, thank you so much for attending. If you haven't registered already, Friday's session is making to be a good one. We're going to talk about all the government programs. We've got an HR specialist on to talk about HR considerations, work sharing, how to access EI, and the rest. So it is posted in the meetup. And if you have any questions, feel free to drop me a line. Thank you so much, everybody, and good luck out there.
Thanks, Clayton. And thanks everyone for
Pete.
attending.
Pete, thank you so much for presenting.
My pleasure. Sorry about all the technical difficulties this morning.
No problem.